Incentive stock options are more complex and do offer benefits to non-qualified stock options. And that involves the calculation of alternative minimum tax, also known as AMT. In order to better understand incentive stock options, what we're going to do is break this into 2 slides. We'll first get a better understanding of qualified versus disqualifying dispositions, and then we'll go through an example to just understand how AMT is calculated and how to use those credits in future tax years. Just like non-qualified stock options, there's no tax implication at grant or vesting. When you exercise, unlike non-qualified stock options, there's going to be no tax withholding. So there's no W-2 income recognized when you exercise an incentive stock option. This leads to the AMT calculation. Again, we'll cover that in just a moment. And in order for this AMT calculation to happen, you have to hold on to the shares until at least the end of the year in which you exercise. After you have exercised the shares, it really comes down to holding period requirements as to whether they will still count as a qualifying disposition. So in order for it to be a qualifying disposition, you have to hold on to those shares for at least 1 year from the date of exercise and 2 years from the date of grant. So that is an and, not an or. So both time periods must be met in order for it to be a qualifying disposition. A disqualifying disposition is anything before those dates have been met. And what ends up happening here is that you will owe taxes, but again, they will not be withheld in payroll tax. So it will count as ordinary income. And the way that tax is calculated is going to be the compensation element, which includes the bargain element, which is the value at exercise less the strike price. So essentially, what gain did you realize when you exercise the shares? And it will also be taking into account any actual gain that takes place after the exercise. So the compensation element is going to be the lesser of that bargain element or the actual gain from the sale. Again, you will owe taxes on this amount and it will count as ordinary income. Any gain above this compensation element is going to be considered a short or long-term gain based on the holding period after exercise. In addition, a 3.8% Medicare tax may apply based on how much realized gains you have in that tax year. Now, for a qualifying disposition, what ends up happening is we will calculate the spread between the exercise price and the sales price, and that will be a long-term gain. Again, this may take into account that 3.8% Medicare tax if the realized gains are significant. To better understand AMT and AMT credits, what we're going to do is walk through an example, but we'll dive a little bit deeper into the tax calculation of AMT. So incentive stock options can trigger AMT, and essentially you're prepaying taxes on the exercise of those shares. This is a parallel tax calculation, and you pay the greater of between the regular tax calculation or the AMT. So the regular tax calculation excludes the spread from the incentive stock option exercise and instead just the exercise price. It'll make a little bit more sense as we go through the example in just a moment. Under AMT, the tax due includes the spread and disallows itemized deductions. So that is important to note when thinking about AMT. You do not have an opportunity for itemized deductions here. There are two AMT tax rates to think about, 26% and 28%. AMT exemptions and phase outs were increased with the 2017 Tax Cuts and Jobs Act. However, those are scheduled to sunset in 2026, pending any future tax changes that may be enacted before then. So we will go on the assumption that they will sunset in 2026. We're going to get into a hypothetical example. In this example, what we're looking at here, and it's important to think that we are not including any other income. This is purely an AMT calculation for simplicity's sake. So let's say you have 100,000 incentive stock options with a strike price of $1 and a fair market value of $4. For regular tax purposes, you will have regular income of $0. The AMT income will be $300,000. So that is the spread between the value on the date of exercise and the exercise price. At 28% AMT tax rate, you would owe around $84,000 for AMT purposes. Now we'll get into the tax basis because they are different between the regular income tax calculation and AMT. So for regular tax basis, it is simply going to be the purchase price. So that $100,000, that strike price times 100,000 shares. For AMT purposes, your tax basis is going to be the purchase price plus AMT income. So essentially the fair market value on the date of exercise, and that will be $400,000. Now, this will lead to differences in how realized gains are calculated in the future for regular income tax calculation and your AMT calculation. This gets really complex, and that's why you'll want to make sure you're working with a tax specialist to ensure you're calculating AMT correctly, but also using those credits correctly for future years. So this is something that isn't just a one and done. You will want to make sure you're using those credits correctly in the future. So in years when you are not subject to AMT with regular capital gains, an AMT credit may apply. And essentially, this is, again, prepaid tax that you can use to offset those realized gains. This annual credit is going to be limited to the gap between the tax due and the regular calculation and the AMT that year. Any excess AMT can be carried forward into future years. So important to note that triggering AMT, even though it can be complex, isn't the end of the world. It's just something you don't want to do by accident. And working with a tax specialist can really help there.